All right, welcome everyone to this session on who benefits from robo-advising. So a few items before we turn to Alberto for the first paper. Note that audio lines on listen-only mode. If you have questions, you can use the QA panel, which you can find at the lower right corner of your screen. Your questions will be answered either directly in the QA panel or during the QA portion of the session, or possibly in follow-up communications, depending on time. So each presenter will have 20 minutes to present a paper, then the discussants will each have 12 minutes to discuss both papers, and time permitting, we'll have Q&A after that. So with that said, Alberto, you're first.
Thank you very much for the invitation to come and speak at this great conference. Can everybody hear me? Can everybody hear me? Okay, perfect. So this is joint work with Stephen Utkus at Vanguard, and the title is, well, the same title of the session is Who Benefits from Robo-Advising, Evidence from Machine Learning. So, and the motivation for this work is that we know that individual investors are not financially savvy. When they're left to their own devices, they tend to make a number of investment mistakes. We know that financial advisors in principle could help, but they tend to be rather expensive, and they also generally ineffective. So we know that they're expensive in the sense that they can only cater to wealthy individuals, and they're generally ineffective in the sense that there are a lot of conflicts of interest between advisor and advisees, and this shows up in the recommendation of the advisors. We know, but potentially robo-advising could be potentially super useful because it is extremely cheap and easy to use, and it can reach millions of people at low cost. But the space is definitely under research. So here I have a kind of map of all the robo-advisors in the space of B2B or B2C robo-advising. And you can see that a lot of companies that are depicted here were not even in existence up to 5 or 10 years ago. So part of the research agenda of mine and the people in this session is to try to understand exactly how do these different robo-advisors operate, what they do, and whether they can be useful for individual investors. So I have another paper in this area. The title is The Promises and Pitfalls of Robo-Advising. And in that paper, what we did is trying to assess the work of a very rudimentary robo-advisor. That was a robo-advisor for individual stocks, and that was deployed in India. And what we find in that paper is that a small part of individuals who are actually benefiting from using this robo-advisors, the majority of people that were already diversified actually did not see much benefits from adopting these two. But the problem with that, or the limitation of that work, is that that robo-advisor was working with individual stocks, and it is really not what most of the robo-advisors are currently doing in the US. And so the fact that the majority of robo-advisors are actually using ETFs of index mutual funds, for example, motivated the work that I'm going to be presenting today. Now, in the same area, I have a kind of a extensive research agenda trying to understand how much complementarity and substitutability there is between man and machine when it comes to financial advice. And even deeper, what do people or what do individuals care when it comes to financial advice, and effectively try to understand what are the needs and wants that the individual have. Now, let me just focus on this paper though today. In this presentation, I'm going to show you the results related to the largest hybrid robo-advisor in the world. This is Vanguard's PAS, Personal Advisor Services. This robo-advisor have experienced explosive growth since its inception. And the paper in a nutshell is going to be what are the main effects that you observe when you enroll for a robo-advisor, and which individuals are going to be the ones that are going to be benefiting more or less from adopting this new tool. Before giving you kind of the summary of the results, let me just give you for frame of references, what would you expect if you were signing up for a robo-advisor of this kind? At sign up, you would be profiled on your risk tolerance, your investment horizons, and your demographic characteristics. Then the algorithm would kind of formulate a comprehensive financial plan for you, which include the recommended portfolio strategy, as well as the probability of financing a secure retirement. At that stage, your onboarding stops, and you have to speak with a human that explains to you exactly what the plan does and how it is formulated. Now, after the approval, so if you decide to sign up for these Robo-Advisors, then the machine trades automatically for you. It's going to rebalance quarterly, so there's going to be no control from the investor's perspective. And this is actually a very unique setting that is common to many robo-advisors, and that is simply that, or maybe I should call them robo-managers. The interesting thing is that post-enrollment, the portfolio allocations are purely mechanical. So it is going to be very difficult to argue that individuals would have made these changes on their own and that the results are not the effect of the robo-advisor. So the point of this paper is going to be to use machine learning tools to understand exactly what are the main levers that are at play and what are going to be the characteristics that are going to be important in determining how your portfolio is going to be changed when you sign up for Robo-Advisors. So this, we think, is going to be informative also for those people that are in the general population. They may have not self-selected into adopting Robo-Advisors. And we use machine learning tools because, as I'll show you, there are going to be significant non-linearities between the effect of robo-advising and the characteristics of the individual investors. As a kind of a frame of reference, let me just summarize the main results. What we'll observe is very large changes in bond holdings and very large changes in cash. We're going to have that bond holdings are going to increase and cash is going to be decreasing. We're also going to have that the investment vehicles of the individuals are going to change. Most of the wealth is going to be placed in mutual funds at the expense of individual stocks and ETFs. And then we're going to have that most of the wealth is going to be placed in index mutual funds rather than active funds. And as a result, you're going to have that the fees are going to be decreasing. Now, in terms of the main mistake that individuals in the US tend to make is that we know that there is a severe home bias puzzle, whereby individuals tend to invest in stocks, in US stocks. So one of the big effects of the robo-advisor is going to be increasing the international diversification of these individuals, and it's going to also increase risk-adjusted performance. In terms of the heterogeneity of the effects, we're going to find that the majority of people that are going to be benefiting more are going to be the ones that have little experience, the ones that were trading a lot before signing up for the advisor, and instead the ones that are benefiting the least are the ones that were already broadly diversified individuals who are in index funds. Now, let me just get into the nitty-gritty. So we have a sample of 350,000 investors that interacted with the Robo-Advisor, not the ones that signed up for it, but the ones that at least started the process. And then we have their individual trades, their monthly positions, their demographic characteristics. We can merge this information with the mutual fund characteristics and stock returns. And effectively, we can have a clear picture of how the investor's portfolio allocation evolves over time, day by day. And in terms of the characteristics of these individuals tend to be rather wealthy. So we have that the average investor has $600,000 in wealth with a median of 282. These investors have 50% of the wealth in equities, 20% in bonds, and 20% in cash. We also have that they are actually well invested compared to many other individuals that are in brokerage accounts. So 70% of their investments are in mutual funds, and they have that 20% of the wealth is in stocks, in cash, and very little of the wealth is stocks and ETF. And we have that indexation is not prevalent, but is rather present. So we have that 50% of the wealth is in index funds, and we also find that there is very little exposure to international funds. So only 10% of the wealth is exposed to international equities. Now, let me just give you a sense of what is going to happen to the portfolio allocation. You'll see that these are going to be extremely dramatic changes. So this is on the x-axis here. I have the number of months before and after signing up. So I go from -12 to +12. And on time 0 is the month where individual signs up for Robo-Advisor. And this is in blue is the average holdings. And we have 95% confidence interval in reds. What you see is that literally the moment the investors sign up, you have this major jump in bond holdings, and these are going to be corporate bond holdings. But you do not only see a big change in terms of the average, you're going to see also a big change in terms of the distribution. So what I have here is, in blue, I have the median, and on the other hand, in the red, I have the 10th and 90th percentile of the bond holdings of these individuals. What you'll see is that after signing in, you will have that a major compression in the heterogeneity across individuals. So there's going to be an homogenization in the portfolio allocations of these investors. When it comes to indexation, you're going to see also a major change. You go from 50% all the way to 85% of the wealth invested in mutual fund moves from active funds into index funds. In terms of international exposure, also a major change. You go from 10% all the way to 30%. And once again, if I show you how much of the heterogeneity I have before and after, you'll see that it actually gets compressed quite a lot. In terms of management fees, and this is kind of the other side of the coin of the active funds, you have that the fees goes from 12 basis points to 8 basis points. But now what I want to show you is something that you would obviously expect to see some move, but you don't see that much. So this is, for example, the equity share. If I was showing you how much of the wealth is invested in equities, you would see that it kind of hovers always around 60%. But this hides a huge cross-sectional dispersion in these investors. So for those investors that have very low equity share before sign up that I have on the left-hand side, these are the ones that sign up with less than 10% of their wealth in equities. This jumps up to 50%. And instead, for those people that are at 90 or more percent of their wealth in equities, it just jumps down to 70%. And we could have gone back and forth and trying to have all these individual kind of univariate plots to show you exactly what the effect of Robo-Advisor is. But what we decided to do is instead to use a slightly different approach. So we wanted to focus on kind of measures of portfolio allocations and measuring investment performance. So we didn't know what characteristics would matter ex ante. In principle, we could have had access to the actual algorithm, but we were not given access to it. So what we decided to do is to not impose any functional relation relating the changes in the portfolio locations or the investment performance and the characteristics of the individuals. So we didn't want to have application, for example, we wanted to let the data speak. And so because of it, we wanted to use a tool that goes under the name of Booster Regression Trees, which is a very well-known machine learning tool. Before getting into a very quick intro to it, let me just give you a reason why we decided to do it. Well, machine learning, we know, is going to be outperforming traditional statistics when we have a large set of potential variables and there are potential nonlinearities and many potential interactions between the regressants and regressors. And this is a typical case when because the data sets are becoming larger and larger in size, machine learning is gaining a huge momentum with finance and economics. And so we wanted to explore if we got traction here using this tool. In terms of the kind of mainstream machine learning algorithm that people have been using, from the least, for the more to the less familiar for economists, we have Ridge and Lasso, we have bagging, random forest, booster regression trees, and neural networks. The reason why we use booster regression trees is that they are very famously known for their good out-of-sample performance, but also their interpretability. And I'm going to be stressing effectively the interpretability of it throughout the rest of the talk. But just to give you a very quick intro, graphical intro to booster regression trees, suppose that I have that the data generating process is this nonlinear regression, is the nonlinear relationship. If I was fitting a linear model, I would get the fit that I have in the blue line. If I was working with booster regression tree after one iteration, what I would get instead is that the region spanned by X is going to be divided in two regions, and the dependent variable is going to be modeled as a constant to the left and to the right. If I have 5 boosting iterations, you'll see that I'm going to start having a better sense of what the true relationship is. And if I have 10,000 boosting iteration, I'm going to have instead that I'm going to be recovering exactly the true relationship. Now, this is something that you could have done in one dimension with any non-parametric method, but exactly the appeal of booster regression trees is that you effectively cheat the cursor dimensionality by doing a non-parametric estimation in many dimensions. Now, why is it very useful and important here? Well, because it's not only going to be extremely accurate, but it also comes with two major tools that help us. One is called the relative influence estimates, and the other is going to be the partial dependence clause. The relative influence estimates effectively tells me which variable mattered the most out of all the characteristics that I have at hand. And the partial dependence clause instead is going to give me a non-parametric estimate of the relation between the variable and each regresses, integrating out the effect of all the other regresses. Now, the first application I'm going to have is going to be for portfolio changes. So I'm going to have the pre and post equity share changes of these individuals, and I'm going to use as covariates all the demographic, portfolio, and trading characteristics that I have available. Which ones are going to be the important variables out of the age of the individuals, whether it's a male or not, the equity holding, the mutual fund share, how much the person was trading before, and so on. But what seems to be the most important is the equity share. So the equity share you were coming into at the time of sign up is what matters the most. And the way you read this partial dependence process is as follows: someone that came in that had 0% of wealth in equities at the lower left corner would actually have experienced an increase in 30% of its equity shares. The ones instead that had 100% of the wealth in equities would actually experience a decline in 30%. Age is also very interesting in a nonlinear. What you'll find is that those individuals that sign up and had at 6 years of age, on average, would actually see no change in their equity holdings. And instead, the young ones would experience an increase in equity share. And instead, the old one, they would, the ones above 70 or 80, would instead experience a decrease in their equity share by approximately 10%. And the interesting thing here is that you'll notice that there is this kind of very strong nonlinear relationship in terms of the changes. And if I was going in and running a linear regression, what I would find is that many regresses would turn out to be significant. I would have that male would be significant, the male down would be significant, if someone is married would be significant, and many other variables like the number of assets. But the truth is that this is purely because the linear model is misspecified. So it's not incorporating the nonlinearities in the variables at hand. The second question we ask is, how much do you observe a change in performance in terms of risk-adjusted performance of individuals? So this is simply a panel regression that we run. At time 0 is when the individual changes or activates the Robo-Advisor. What you'll see is that you have a steady improvement in the portfolio location on a risk-adjusted basis, or expected return risk trade-off basis. So when we, in further results, what we do, we decompose the effect of the expected return and the one in volatility. And what we actually find is that the majority of the effect comes from the increased diversification and lower volatility of the portfolio. You don't see a big increase in the returns of the individuals. Of course, there is potentially a endogeneity issue here. We have that potentially you have that those people that signed up were the ones that had a particularly bad performance before signing up. So what we actually can do is construct counterfactual returns for those who signed up, for those periods when they were not signed up, exactly because there are mechanical portfolio locations for individuals that have similar characteristics. And we actually find that the results are very similar there. Then what we do...
About 3 minutes left.
That's great. Then what we do next is the following. We say, okay, we can compute the within individual changes in the abnormal Sharpe ratio. So how much does your performance change before and after signing up compared to the performance of the market? And if the effect of the Robo-Advisor was null, you would expect that this density would be centered at 0. Instead, what we find is that it's shifted to the right. But of course, we have that some individuals are actually worse off compared to before, and some individuals are going to be better off. Of course, this can be driven by random variation. So an individual that was invested in 3 stocks and maybe Google, Facebook, and Tesla was basically worse off by signing up for a Robo-Advisor, exactly because this extra diversification came at the cost of not having access to those stocks that kind of increase in value like rockets. But what we can do is go in and see exactly what are the characteristics of individuals that benefit more and the least. What we find is that those individuals that had very little tenure, so the ones that were not very experienced, benefit a lot, and the ones that were more experienced benefit least. People that had more cash benefit more. The people that had a higher percentage of wealthy mutual funds before signing up benefit less. And you're going to have those people that trade a lot before signing up benefit more, and the one that had instead a lot of indexation benefit the least. What you'll notice is that there is also a very non-monotonic relation between the number of assets and the benefit. You have that the ones that benefit the most are the ones that had approximately 15 assets, and instead the ones that had very little assets or the one that had a lot of assets benefit the least, likely because the ones that had few assets were already invested in index mutual funds or in ETFs. In the last part of the paper, and I only have 1 minute, what we do is we go beyond performance and think about the side benefits of signing up for an advisor. Here, what I'm showing you is the attention an individual place to their portfolio performance, portfolio allocation after signing up. So at time zero, individuals tend to pay a lot of attention, but as soon as the time goes by, you can see that after the first period where they monitor the Robo-Advisor, you actually have that individual start spending less attention to their portfolio allocation. When I split the attention between desktop computer and mobile app, what you see is that the desktop computer attention goes down. The one in mobile app instead stays up over time. And if I don't look at logins, but I look at minutes, what you find is that the attention in terms of minutes goes down everywhere, meaning that people monitor the Robo-Advisor or they know their financial situation very often, but they don't really spend time thinking about what to do with their portfolio allocation or which stocks to buy and to lose. Then I don't have time to present this, but in the paper we studied the determinants of Robo-Advisor sign up, the determinants of Robo-Advice attrition, and here we see there is a huge importance of the hybrid component. We have that those individuals that have contact with a human advisor, even if they are robo-advised, actually tend to stay around much longer compared to the ones that instead don't have interaction with a human. Finally, so Robo-Advice has the potential to tremendously benefit investors. It has the potential to disrupt the entire financial advisory industry. Right now, it's still rather simplistic, and maybe for good reason, but I'm going to be excited to hear the comments of the discussants and also the implications for financial inclusion that Michael Ray is going to present now. Thank you.
Wonderful. Thank you, Alberto. Our next paper will be presented by Michael Ray.
Great. Thanks so much to all of the organizers, to Alberto for presenting his very interesting paper, to Asani, and to all of you who are tuning in today to listen. My name is Mike. Can everyone hear me? Alberto, can you hear me? Okay. Just to repeat what I just said, thank you so much to Alberto for presenting a very interesting paper, to all of the organizers, to Asani, and to all of you who are tuning in today to watch. My name is Michael Ray from UC San Diego, and today I'm going to talk about my paper, Does FinTech Democratize Investing?, which is joined with Stas Sokolinsky of Rutgers Business School. The broad motivation for our paper is the observation that wealth inequality has really soared over the past 4 decades. And it's being increasingly recognized that less wealthy households earn a lower return on their financial assets relative to wealthier ones. And in fact, only 24% of US households outside the top quintile of the wealth distribution own stocks at all. Today, we're going to ask whether technological innovation in finance, that is FinTech, can reduce inequality in financial returns. To prime the pump a little bit, let me begin with an amusing quote from The Economist magazine. The wealth management industry stratifies customers in a manner similar to airlines. High net worth clients to fly business class, picking stocks and chatting with named advisors. Middle class gets no service at all. Technology is conspiring to change that. Today, we're going to study Robo-Advising as an example of FinTech that introduces asset management for the so-called cattle class. The particular product that we'll study is a well-diversified and automatically rebalanced portfolio. As Alberto mentioned, what's unique about robo-advisors is they rely on automation to manage this portfolio, and subsequently, they can afford to accommodate relatively small portfolios because their per portfolio management costs are very small. In particular, we're going to study a reduction in account minimum by a large US robo-advisor from $5,000 to $500 in July 2015. This is actually a pretty big reduction relative to the median US household's liquid wealth of $17,000. To think about it differently, this means that half of US households would have needed to invest at least 1/3, specifically 5/17 of their wealth, just to gain access to the robo markets through this advisor. After the reduction, however, they need to invest a much smaller share. Today we're going to focus on how this reduction affects such modestly wealthy households' financial condition. As a necessary first step, we need to ask, does this reduction bring them into the robo market? By which we more precisely mean, does it relax constraints on their ability to invest? Second, by entering the market, does these households' financial condition improve? We find that the reduction indeed democratizes the robo market by bringing in households from the second and third quintiles of the overall US wealth distribution. The so-called middle-class households are 15 percentage points more likely to participate after the reduction as opposed to before the reduction. We do quite a lot of work in the paper to evaluate what the relevant channel is, and most of the evidence seems to suggest this operates through a relaxation of investment constraints. We find that the new middle-class robo participants experience a 2 percentage point increase in their expected return relative to the upper class. And this is the sense in which the reduction reduces inequality in return between the upper and the middle classes. However, we find the reduction has no effect on households from the bottom fifth of the US wealth distribution, whom we shall call the middle class. Therefore, we interpret the reduction as a Pareto improving technological shock that has an ambiguous effect on wealth inequality because it appears to favor the middle over both the upper and the lower classes. It's actually an interesting result because it contrasts with the well-documented inefficiencies in the active asset management space, which are different than the results that we find in the passive asset management space. I'd also like to point out here that our conclusion is principally qualitative as opposed to quantitative. We are interested in how this particular example of FinTech, Robo-Advising, affects households' financial condition across different points in the wealth distribution, as we're focusing on the distributional impact. This is in contrast to trying to quantify the aggregate statistics such as the effect of robo-advising on stock market participation. And we're focused on the distributional, qualitative aspects of robo-advising. The theory we have in the background of our mind begins with the idea that asset managers require some account minimum, which may, for example, be that they are to cover fixed costs of portfolio management. Households have some optimal allocation to the asset manager called omega. We can think of this omega as solving some portfolio choice problem wherein households have a preference for delegation to an outsider. Now, the account minimum is going to constrain households differentially according to their wealth. Some households may just not have enough money to overcome the minimum. So in our setting, maybe a household just has only $4,000 in liquid wealth, and they can't invest $5,000 to overcome the previous minimum without borrowing. Or the household may indeed have enough wealth to overcome the minimum, but doing so would require investing such an excessive amount of their wealth they choose not to do so. So in our setting, maybe a household with $10,000 in liquid assets could in principle invest under the old minimum, but they find it unattractive to invest half of their wealth with this asset manager, with this robo-advisor. Enter robo-advisors who use automation to reduce the minimum to some lower threshold, let's call it middle M, less than the initial minimum, big M. Theoretically, this should increase robo-participation by constrained households who principally are in the middle segments of the US wealth distribution. By contrast, we wouldn't expect there to be an effect on households from the upper class, who were never constrained by the minimum to begin with, or by households from the lower class for whom even the new, smaller minimum is still too high a barrier for them to attractively invest with the advisor. We'll test this hypothesis using data from Wealthfront, which is a so-called pure robo-advisor as opposed to what Alberto called a hybrid advisor. That is, Wealthfront offers no option for human advice, but what it does offer is an automatically rebalanced portfolio of 10 ETFs that span 10 asset classes. Now, importantly, the portfolio weights are determined solely by the response to a risk tolerance questionnaire. Like in Alberto's paper, the implication here is that investor sophistication will not affect a household's robo-return. This is not a situation where the robo-advisor says, hey, go buy X, Y, and Z, go do it. No, this is a situation where the robo-advisor will itself buy X, Y, and Z, and whether you're the most sophisticated smart money or the dumb money like myself, you will receive the same portfolio conditional on having the same demographics and subjective risk tolerance. Management fees are relatively low across advisors, and in particular, they're 0% for accounts under 10,000 at Wealthfront and 0.25% otherwise. Our particular data set is a panel of Wealthfront clients' deposits over 2014 to 16, which nicely straddles the reduction in 2015. We observe demographic information such as the age, income, state of residence, subjective risk tolerance, and liquid wealth, all of which are static and reported by the household. This figure plots the wealth distribution of existing robo-participants and new robo-participants. New robo-participants are those who join Wealthfront after the reduction. We see there's a sharp leftward shift in the wealth distribution of robo-participants because the new participants have less wealth relative to the existing ones. Relative to the overall U.S. population, most of the growth comes from households who are in the second and third quintile of the overall U.S. wealth distribution. We'll illustrate that in this figure by plotting on the horizontal axis each of the 5 different quintiles of the U.S. wealth distribution, and on the vertical axis we'll plot the share of robo-participants from each of these 5 quintiles. Again, to point out that in relative terms, the growth is greatest from households from the second and the third quintile of the overall U.S. wealth distribution. By contrast, there's actually a reduction in the share of households from the 4th and 5th quintiles, whom we'll call the upper class. And notice again, there's no change in the share of participants from the bottom quintile, the so-called lower class. And this is the sense in which the democratization is incomplete. In terms of the dynamics, this figure shows how the shift in the wealth distribution coincides exactly with the reduction in account minimum. Explicitly, we'll plot the log of new robo-participants for the second 2 quintiles of the U.S. wealth distribution and the top 2 quintiles each month. And notice we have a flow variable on the y-axis. And so the fact that it jumps up and remains elevated for the middle class indicates that this reduction is going to have long-term effects we may not pick up in our sample. In terms of the relevant mechanism, in this figure, we'll plot the share of initial deposits that are exactly at the previous minimum of $5,000. Notice, per the blue line, the middle class exhibits a sort of bunching behavior prior to the reduction. Namely, 60% of initial deposits by the middle class are right at the initial account minimum. Afterwards, however, this behavior goes away and the middle class begins to simulate the upper class in their investment. By symmetry, there's a sharp jump upward in the share of initial deposits from the middle class that are between the old minimum and the new minimum. Now, the share, of course, is mechanically 0 before the reduction because you were not allowed to invest less than $5,000. This figure, combined with the previous figure, is certainly suggestive of a relaxation of investment constraints on the middle class. Now, to test that hypothesis, to test that channel more rigorously, we're going to estimate the following regression equation. The outcome variable, nu I, is an indicator for whether household I becomes a robo-participant after the reduction as opposed to before the reduction. Notice that I'm using the word after versus before. The reason is because we're going to estimate this equation on the set of eventual robo-participants, that's actually the appropriate set of households on which to estimate the equation, because we are interested in the share of robo-participants who are brought into the market through a relaxation of investment constraints. That is, we're interested in the democratization of the robo-market. The explanatory variable, middle I, indicates if household I belongs to the middle two U.S. wealth quintiles as opposed to the upper two. Recall from the graphical evidence that these middle-class households are the ones that behave in a way that suggests they experience a relaxation of investment constraints. And in that vein, there's actually a latent first stage in this regression equation. We'd like to regress some indicator of whether household I is constrained by the minimum on this middle indicator. Now, because we don't observe this latent variable constrained I, we're going to make the following identification assumption. In words, what we assume is that unobserved factors that affect whether a household is constrained by the minimum do not also affect whether the household becomes a participant after the reduction as opposed to before the reduction. Now, importantly, this assumption is conditional on a wide battery of household characteristics such as income, state of residence, subjective risk tolerance, and most importantly, the household's age. We do quite a lot of work in the paper to evaluate the validity of this assumption, but before getting to some of those exercises, let me show you the baseline result. In column 1, we find that middle-class households are 14 percentage points more likely to become robo-participants after the reduction as opposed to beforehand, relative to upper-class households. The omitted group here, the control group that is, are upper-class households. In columns 2 through 4, we evaluate whether the middle indicator is a reasonable proxy for whether a household is financially constrained. For example, in column 2, we find that new middle-class robo-participants are 30 percentage points more likely to invest under the previous minimum relative to new upper-class households, which suggests they experience a relaxation of constraints. In column 2, we find that they are 43 percentage points less likely to have owned stocks prior to becoming robo-participants, which again is suggestive of a relaxation of investment constraints, because if new middle-class robo-participants had instead participated in the stock market at the same rate as new upper-class participants, it would suggest that their preference for delegation is sufficiently low, and they could have just replicated the robo-portfolio on their own before joining the advisor and so were never constrained. That said, we find that's not the case. I should point out here that we don't actually directly observe whether a household is a stockholder or not, and rather we follow what we do is we impute stockholding status using observable characteristics applied to the Nationally Representative Survey of Consumer Finances, using a variety of traditional and machine learning-based imputation methods such as those described by Alberto. Lastly, in column 4, we're going to evaluate a form of intertemporal constraints. And specifically, it could be that new middle-class households are just at an earlier stage in the life cycle. And while indeed they're constrained in terms of wealth, they're constrained in terms of wealth because they have not yet accumulated enough assets to overcome the minimum. However, we find that new middle-class households are no more likely to be a millennial relative to new upper-class households, which suggests that this intertemporal form of constraints is not the dominant constraint that's being relaxed. Rather, what appears to be going on is that this reduction is bringing in households who are in some sense permanently constrained, who are low wealth at any stage in the life cycle. A separate question is whether the new robo-participants remain persistent in their investment behavior. And to evaluate that, we will do the same exercise after, in column 1, restricting the sample to households who never withdraw funds, in column 2, who make a follow-on deposit, and in column 3, who set up a retirement account, namely an IRA, which has very costly early withdrawal penalties. The fact that we find similar results across all 3 subsamples suggests that these new robo-investors from the middle class are not simply fickle investors who run away shortly after investing. And we can estimate an analogous panel-level regression also that allows us to test for heterogeneous visibility of the robo-advisor. For example, in column 1, we find no evidence that the middle class is responding due to differential exposure to news coverage of the Robo-Advisor. In column 2, we test more formally for pre-trends by estimating an event study research design. And consistent with the graphical evidence, we find that the change in middle-class robo-participants' investment behavior occurs exactly with the reduction in account.
You have roughly 3 minutes.
I'm using the word robo and wealth-front participant synonymously. It could, in fact, be that this is not a switch in robo participation status per se, but rather an unobserved decision by the household to turn down an investment opportunity with a separate robo-advisor in order to invest with wealth. It's really tough to make progress on that question without having data on every single robo-advisor in the world. But the best we can do is to turn to admittedly rather coarse data from the SEC that records the number of clients at each advisor. Based on this admittedly coarse data, we do observe that there is no reallocation away from other advisors to Wealthfront, as evidenced by the relatively flat red line in this figure. We'll estimate the effect on formally constrained households' total return, or total return is defined as the expected return on liquid assets, using the following two-period equation. The second period, big T equals 1, is the post-reduction period, and big T equals 0 indicates the pre-reduction period. We'll take first differences to arrive at the second equation shown on the screen. The first outcome, delta Y, that we'll study is a household's change in risky share. To a first order approximation, the change in risky share is equal to the post-reduction investment with the robo-advisor divided by the household's liquid assets. What we're really more interested in is the change in a household's total return, which we'll calculate as the change in risky share times a measure of household I's risky robo-return. We'll measure risky return I using a variety of methods, and just for the sake of convention, our baseline will be the expected return implied by the kappa. Now, there's a separate question of whether an increase in total return is welfare improving. Without imposing a model, it's impossible to know for sure. But there are three reasons why we think that it's likely to be welfare improving. The first is that robo-portfolios in our sample tend to be very well diversified. By that I mean that the share of total risk that is uncompensated as opposed to compensated is small. It's around 4%. Second, the increase in the level of risk is consistent with coefficients of relative risk aversion between 7 and 12, which, if anything, are relatively large and thus suggest that households are not taking an excessive amount of risk. And third, while we don't observe directly all components of a household's financial income, while we only observe the level of liquid wealth, not its constituent components, based on our machine learning imputation, over 60% of new middle-class households are making a first-time stock market investment. And this suggests that the increase in robo-investment is not welfare impairing because of adverse correlation with other components of a household's financial income, because there is no other component of a household's financial income except for that earned on a checking account. So these are the three reasons we think that an increase in total return would be welfare improving, although of course we have to use the word welfare improving in cat's ears. We find that new middle-class households experience a 1 percentage point increase in total return relative to new upper-class households. And the results are particularly strong among households from the second quintile of the wealth distribution, as these lower middle-class households experience a 2 percentage point increase in expected return relative to the upper class. And this all brings us back to the paper's initial motivation. We found that this reduction in account minimum reduced constraints on household ability to enter the robo market, and consequently, it raised the expected return on liquid assets for the middle class relative to the upper class. However, the fact that it has no effect on the poorest wealth quintile leads us to conclude that this is a Pareto improving technological shock that has an ambiguous effect on overall wealth inequality because it appears to concentrate the gains on the middle class. Thank you so much for your time, and I look forward to your thoughtful comments and to the comments of Apurva and Francesco. Thank you so much.
Excellent. Thank you, Michael. So our first discussion for this paper will be Francesco da Cunto.
Great. So let me thank Azani and the organizers for asking me to discussing these two great papers. They're really among my favorite papers on robo-advising right now in the literature, so I'm very happy I have this chance. And I'm showing you here a picture that Alberto's already showed you. So, we are co-authors, and I think we think very much alike. But just to emphasize how fast has the environment for robo-advisors, especially in the investment space, grown in the US recently, not only in terms of robo-advisors for business to customers and customer to customers applications, but also robo-retirement and investing tools. Now, this is exactly the type of space on which these two papers that we just saw presented focus. Now, what I would like to do in my discussion is, first of all, focus indeed on this area, which is how to use robo-advising in the context of investment. This is this kind of red ring I'm showing you here in this slide, but also towards the very end, give you some hints, some information about the way in which robo-advising has been much more recently used, even more broadly than just for investment applications. And in particular, robo-advising in the context of providing advice to consumers in order to think about how to balance their balance sheet management, as well as individuals becoming lenders. So this intermediation through peer-to-peer lending, which can be extremely improved, as we will see in a few slides, to robo-advising. But so let's start with the robo-advising for investors, which also allows me to give some comments about the two papers we discussed. So first of all, when we think about robo-advising, we should ask ourselves, what is robo-advising? How does this really differ from the traditional forms of advice we've always seen? And so with Alberto, we have this review article forthcoming in the handbook of technological finance, in which basically we emphasize two crucial features of robo-advice relative to other forms. The first one is that this advice is produced automatically by machines and algorithms. This is the crucial thing that we all think about when considering robo-advisors. The second crucial feature is that this advice is made very easy to execute for the individual investors. So it's still advice that is provided to investors, and investors can decide whether they want to follow it or not. But if they want to follow this advice, this is made logistically simple. And so to sort of show you what I mean by that, here, for instance, I have an example of one of these robo-advisors. This is based on some work. We also have the promises and pitfalls of robo-advisors. This is a robo-advisor called Portfolio Optimizer. On the left screen here, what you can see is that the individual, when logging into their account, they basically observe their old existing portfolio with this company, with this robo-advisor. What does then this Portfolio Optimizer do? In the right-wing screen, first of all, it provides an analysis of the current portfolio, which is the industry distribution here in the middle, but also provides an analysis of what would be the distribution of all the investments in the portfolio if the investors decides to take up this robo-advice. So it provides a very simple comparison if you want some kind of a financial education role of these robo-advisors, to explain them very well what is the difference if you decide to move to the new portfolio. Now, then the advisor retains the decision on whether they want to move to the new portfolio. So what they do is that if they want to move to the new portfolio, there is a button they can click here that I'm circulating in red. If they click on this button, then all the different trades that are implied in order to move from the portfolio that exists from the left to the new portfolio to the right, all these trades will be automatically executed in batch mode. So the investor retains full decision-making authority on whether they want to move, and they're explained very well what are the differences between moving or not. Now, in this type of setting, for this type of robo-advisor, what we found, for instance, in that paper is that the results are a bit, light and shade, in the sense that certain types of investors definitely benefit from this form of robo-advising, which is cheaper. They have higher diversification. They tend to have, on average, higher performance. The amount of fees they pay stays more or less the same. But the most sophisticated investors instead are made worse off by this form of robo-advising, largely because they start to use these machines, these optimizers, too often. So they want to re-optimize their portfolio very often, so they end up paying too high fees. The amount of fees they pay to the brokerage increases substantially, which is what we would call the pitfall of these forms of robo-advising. that provides still the individual with authority to decide. Now, why did I introduce robo-advising in this way? Because I think the first point I would like to make is that what we call robo-advisors is still in the papers we saw presented, and more colloquially in the private sector in the US, is a bit different from what I showed you before. So what I would call them, and what I called them in this article I mentioned earlier, is more kind of robo-managers. So as Michael also mentioned, and as, for instance, I remember when talking to the CEO of Wealthfront once, the idea of the robo-manager is really that individuals should provide their money to these robo-managers and then forget about it. The robo-manager will go on autopilot. The person is never asked anymore to provide feedback. So once you are in, unless you decide to get out of the robo-manager, this will be an autopilot. Now, if anything, I remember the CEO of Wealthfront told us what we dream is that people leave the money there, forget about it, go to sleep, and then maybe when they need the money several years in the future, they come back to us. They have to leave it, go in autopilot. Now, we can think about this as an extreme form of robo-advising in the sense that they give people mechanically all these assignments, but crucially, these robo-managers differ because there's no involvement of an individual over time. And we will see this is an important point, especially thinking about Alberto's paper, as I'm showing you right now. So going directly to the two papers that we've just saw. So in terms of the paper Alberto presented, who benefits from Robo-Advising, I think that the setting there, which is also shared by Michael's setting, is extremely interesting and extremely valuable, especially for academic economists who really think about understanding causal effects, in large part because all these robo-managers have very predefined and mechanical portfolios that they assign to people. So why is this then important? Because once we account for the decision to adopt the robo-advisor per se, when we compare the different performances of different people that are into the robo-advisor, this is completely exogenous relative to the individual characteristics of this. And why is that? Because it's the robo-manager that assigns mechanically to them the different dimensions. So there is no characteristic of this individual endogenously entering the robo-advisor that defines the composition of these portfolios. I think this is a crucial point, and I emphasize it, especially for all of us academic economists here, because sometimes there is confusion about this point. I think people believe that you can only estimate causal effects if there is some kind of randomized experiments or whatever, exogenous shock. No, so what we need is that there is no way in which unobserved characteristics of the individuals can make any sort of determination or correlation with the ex post assignment of the portfolios, which is by construction not true here, given that these portfolios are assigned mechanically. So the person has no role in deciding anything about these portfolio compositions. Now, this is the pros of the paper. What is, I think, the challenge that I would like to raise to Alberto and to the others that have worked in this area? Well, given the fact that these robo-managers by construction don't ask people to be involved in any way over time, there will be potentially a situation in which people become disengaged with their finances. What I'm showing you here is a picture from a recent paper by my colleague at Boston College, Jonathan Reuter. And so what they compare here is individuals in blue that are actively managing their portfolios and individuals in red that instead are in robo-managers, so they don't actively manage. So if you look at the extent to which these people check on their finances and know what is going on, of course, by construction, given they don't have to make any choice, they become less interested in following what's going on. So why is this a problem? Because as far as the accumulation or investment phase is concerned, when these people have to accumulate wealth over time, we are fine with that. I completely agree with the Wealthfront CEO. We would like people to just forget about putting their hands in there. But then the problem is in the accumulation phase, after these people have retired, and at that point they will have to make important choices on how to use the money they have, what to do in terms of transforming them in annuities or not. All these decisions, if they've not taken care of their finances throughout their lifetime utility, will be potentially very hard for them to make. So we are basically not giving responsibility of people for their finances in the long run. This potentially could be. Now, going to Michael's paper, also extremely interesting setting. The robo-manager is kind of similar over here. Michael, I think, did a great job in presenting it. The main point I think they have, which we see clearly in the data, is that the average returns across the distribution converge across the wealth distribution, especially driven by kind of middle-income class households. I would say that gain a bit more relative to what they were gaining before. So I think one challenge that I would suggest the authors to think about is, here, of course, we want to try to make potentially welfare consequences. Clearly, Michael also said we cannot for sure say anything, but I think one episode that happened in the UK could be informative to understand this type of results. So this was the NEST program. Maybe many of you in the audience are familiar with that. It's basically a situation in which the UK tried to make it very easy for people by reducing the amount of money they invest, sort of logging into retirement target date fund. And so what happened is that as this program and the fees and the amounts people that to contribute were reduced over time from 2013 onwards, the amount of people that enrolled to this type of investment increased dramatically, as I was showing you here. But then, and indeed, then these people were often people that were having low returns because they were keeping their money in cash. Now they started to enjoy the equity risk premium from the stock market. But what happened at the same time, given that these people were giving their money to the Robo-Manager, they didn't have cash to finance their regular spending. And so they started actually to take on very expensive debt, either credit card debt or even payday loans for those in the lower part of the wealth distribution, which then made them realize extremely negative returns in the sense that they had to pay extremely large returns on all this money that they were taking for debt. So of course, unfortunately, this is something on which we cannot say anything just with the data from the Robo-Manager, because in the Robo-Manager, we observe the data that is invested there. We don't know what people do on the liability side of their balance sheet. But this is something I think to keep in mind, because then are we sure that democratizing access to the stock market in this sense is necessarily beneficial to these people? So my time is basically almost over. So just very, very briefly, I wanted to mention at this point that, first of all, Robo-Advising has also been very recently used in other contexts. One of them is consumers, so providing people through income aggregators with a very clear view of their assets, liabilities, as if they were a company, a situation in which a lot of households that are not financially literate find very, very helpful, because it allows them to think about the matching of their plus and minus sides, which is not obvious for somebody who doesn't have any kind of background in accounting or finance. And we studied in some papers also settings in which these income aggregators provide advice and change the spending behavior of individuals. This same Robo-Advising has also been recently used to sort of improve peer-to-peer lending situations. So this is also from some ongoing work we have with, in this case, a peer-to-peer lender in India. And so what's the idea here? Well, traditionally, peer-to-peer lending has been not really a very good promise, as what seemed at the very beginning, because all these platforms have extremely high default rates. People don't understand what they're doing when they provide money as lenders. What this Robo-Advisor for lending does, in this case, this is called FairCent, is actually that it provides portfolios of loans that lenders can directly buy in. So the individual lender doesn't have to assess the borrowers anymore directly on their own, and they don't have to match entirely with one only borrower, but they can purchase a bundle, a portfolio of borrowers in which they invest only a certain fraction, and this is produced and optimized by Robo-Advising. So we believe this could be a frontier also for the private sector, in which the application of Robo-Advisor increases this intermediation through making it easier for individuals. All right, so my time is definitely over, so I think I'll leave you just with these three pictures. So let's think about Robo-Advising in the investment setting, but also the fact that Robo-Advising has been recently also opening up other parts of the household balance sheet. Thank you all very much for the chance to discuss the papers.
Thank you, Francesco. Our second discussion for these two papers is Apurva Mehta.
Hi, can you all hear me?
Yes.
Okay, excellent. So I do not have any slides to present, so I'm just going to go through the couple of insights that I got from the two papers that I read. First of all, at the top of the discussion, I just want to bring up the word robo-advisor is a misnomer, the same as what Francesco said, right? It's more of an ambition It's really right now just a portfolio optimizer, right? And most of them are simply doing a optimization of portfolios. They keep charging a perpetual fee though, but it's smaller, but it's a perpetual fee. Like somebody mentioned that, the Wealthfront CEO saying, oh, well, they should just leave the money and we can charge them forever. That's, maybe not a good idea. But anyway, so we go on further and we think about that. These robos are offering low-cost mutual funds and ETFs. From the paper I saw, the 4 Vanguard funds. Now, why would some investor not just pick them and be done with it? Why would I pay an extra fee to pick those up as well, right? If I had to do a 60-40 standard investment, equities, bonds with index funds, I can do that too. I don't have to pay a fee for that. So when we start to think about advice is beyond just portfolio management. And the question that it raised in my head is, how does a even a portfolio manager, account for long-term trends, right? The growth of Asia, the macro geopolitical influences that affect each investor's portfolio? Or should we just ride through the volatility? If investing is truly democratized, will such robo-advisors hedge against deep market losses? Would they have advised before the market crash of 2000 and 2009? Or they would say, you know what, we'll just rebalance and move on. So how do you handle the emotional fallout from that? How do you prevent users from buying high and selling low? So there was this reference of a hybrid advisor, right? The hybrid advisor, in the case of Vanguard, there is a PAS where there's this human that has this first interaction, and then it goes into a machine mode. I don't call that a hybrid. I call that still a robo, because after that you're in machine mode. A hybrid is truly an augmented advisor, right? There is a manual intervention every so often. Most of the time you are in a machine mode, but there is a human interaction that happens point to point, maybe once a quarter if needed. So the ETFs and mutual funds recommended are based, again, another point that Francisco made, it's from preset strategies. That's a risk, right? Are they from the full universe, from a subset? How do you account for new offerings and new products in the marketplace? How are they brought into these robos? The other piece that we talked about briefly, I think, Francisco, you ran out of time a little bit. How do you manage both sides of the ledger, right? It's not just the assets you manage, you also manage liabilities. Where your spending is, how do you optimize those liabilities? Because the word is really optimize. You're not asking people to reduce their spending. You're looking for them to optimize their liabilities. So, and most of these aggregators are selling me credit cards, right? That is not what they should be doing. They should be advising me on why my liability, should I refinance? Should I look at a different opportunity on my mortgage? This is a great rate that just came by across the entire universe, not only for their advertisers. So there is an inherent conflict in some of these robos and in these, even the aggregators. As you start to go through the various offerings, I mean, the options, the overseas diversification that one of the papers referenced, are there currency hedges? Can they handle options for hedging? Can they do any other complexities? No. Right now, they are very, very basic, and they are very, very simple portfolio allocation models. And that is a little bit of concern, and that is probably the reason why you're not seeing an uptick in the adoption. It's still taken, we are into 20 years of these robos now, and only one of them has crossed 100 billion in total assets. Like it's hard to gather assets when you are dealing with some very, very basic strategies. I'll say all this with a caveat for now, okay? Until now. I'm not saying that all of this is true, and I don't think that all of this remains true going forward. I'm just saying that right now, the way they operate today, it's about portfolio allocation and only. The second point that kind of raised a little bit of concern for me, and then I thought it was considered as a good thing, but to me, that raised a concern. That, there was this statistic that, in the first month, these investors checked a lot of times. The second month, they checked less often. And as time went on, they checked less and less, right? it concerns me. It concerns me, is that really good? Is the goal for the investors to be in the market but have no knowledge of it? It's like, turning on the autopilot on your car and hope you get to your destination. Mostly you do, but sometimes you don't, right? Sometimes you got to grab that steering wheel yourself. There are really 8 dimensions of wellness, right? Financial wellness is one of them. There's also intellectual, spiritual, physical, emotional. All of them require work. I just don't sign up for a gym and hope that I get physically fit automatically, right? I got to put in the work. And I think that the same applies. One of the things that I am finding is that are these fintech robos simply exploiting a gap in the lack of financial knowledge of the populace? And instead of educating, and instead of actively, the training and democratizing that, would it make sense to do that and get people more educated about their financial wellness? Because that is what is important, right? You've got to put in the time to understand, to spend the time. No one's going to go to college or give you a degree without you attending class, right? I'm not just paying a fee and getting a degree. Somebody's got to do the work. So that educational wellness, similar financial wellness, you have to know what you're doing. What should the robos do? I think that, the education and training, clearly that. Move beyond portfolio management. Do some anticipatory and predictive algos, right? Don't just tell me I'll rebalance every quarter. That's after the fact. Start to do some predictive stuff. Do it ahead of time. Start to optimize that. And there's enough data out there. People are doing it all the time. For robos to democratize that should be fairly straightforward. Start to look at macro trends, look at demographics, look at age-based advice. Start to look at customizations, make it a segment of one. Don't give me preset strategies and hope I fall into one of those buckets. Most people trade badly, but they trade because they like to. And the ones that don't like to, don't trade anyway, right? And so the point being that what they're trying to fill is simply leveraging the lack of education in the industry, which is something that needs to be addressed right away. Really, an index fund is good enough for most investors that are the target of both those papers, right? Buy yourself an index fund and just, if I can argue that the S&P index fund adds and removes companies actively, I would even argue that is an actively managed index fund. So that's good enough, right? So the only thing is, I will say, there was this headline that said financial advisors are too expensive. Well, I kind of disagree, right? It depends on the assets you hold and the advice you want. If you want just the portfolio advice, you're right. But if you want somebody to help you through, how do I save for school, and where is the 529 getting set up, and should I set up a trust, and how do I hand over finances to my later generations? Where do I go look for funding opportunities? Start to build that into these algos, because eventually these, you talked about the quintiles of the investors, they are eventually going to move up the scale. And so to try to prepare in that space would be good. That would be where I stop.
All right. Thank you, Apurva. So we are getting reasonably close to the end of the session, but I want to give each author the opportunity to respond to the discussion or add any points you think would be useful. So Alberto, do you want to go first?
Yeah, so let me just take the moment to thank very much Francesco and Apurva. And then I just wanted to mention, I think, 2 or 3 things. So the first one is that Apurva was basically saying that, you can have a ETF or an index mutual funds and have that is going to do the portfolio allocation for you. And so you don't need robo-advice. The problem with that kind of attitude is that we know that is not true, right? So we know that if you tell individuals what to do, we have research papers that have done it. So they send information for free to individuals, say you should buy A, B, C, D, this ETF, and they just don't do it, right? So it's the same way you can argue like, oh, you don't need diets, because you can go online and you know that you can have a very healthy diet, you can lose weight, but this is not what people do, right? So they're not capable to do it. And then the second part, I totally agree that portfolio allocation is actually not everything that people look for. And in fact, I actually have a paper on it. It's called The Needs and Wants of Robo-Advice. That is, we go exactly at the core. Individuals don't care about only the portfolio allocation. But that's why also these robo-advisors, we cannot measure them. And then that's why it's not in the paper. But all these robo-advisors, they actually have, for example, PAS will have, give you access to a CPA, will give you access to a financial advisor, will help you set out college funds and do all these auxiliary all these auxiliary functions. The difference is that instead of having a financial advisor that charges you 2% per year and maybe have 40 or 50 advisors, you're going to have now an advisor will have 200 or 300 customers, and the portfolio allocation will be taken out of their hands. But you're going to have that they'll still will act for you as CPAs and do all the auxiliary service. This is what the advantage you get is that of spending 2% per year, you're going to spend 30 basis points per year. And now, in fact, you actually have the pure robo-advisors that do exactly what you say they do, purely only the portfolio locations, will actually be given to you for 10 basis points per year. So then we're going to be starting competing with ETFs and index mutual funds. And that's all I have to say. But thank you so much for the points. I think they were very well taken. And thank you, Francesco.
Great. Again, to reiterate what Alberto said, thank you so much, Francesco and Apurva, for your very thoughtful and excellent comments. So I agree with everything that Alberto said, and just adding a few additional points to that. Related first to leverage, second to education, third to the sophistication of the allocation, and fourth to persistence. On the point of leverage, this was mentioned a little bit by Apurva and as well as by Francesco quite a lot at the end of his discussion. Yes, I agree. I think it's at least within our paper in particular, we do have a fallback, and we have an issue in that we can't observe both sides of the balance sheet. And you're right that it is important to see both sides. All I can say is that based on what we do observe, we just do the best we can, and in terms of trying to quantify the welfare gains. That's a very good point. And on that point, actually, on the industry side, Wealthfront is actually now moving a little bit more towards a model where it provides households holistic financial advice, how to manage their debt, how to manage their savings, et cetera, et cetera. The other way in which Wealthfront has sought to grow, and this gets more into the sophistication of the allocation side, is to try and give households more sophisticated products. I completely agree, Apurva, that it really is. Matching the sophistication of the best hedge funds is that's probably not going to happen in the robo space. But what these advisors are trying to do is to say, for example, going from just a pure index plus, as we might call it, trying to give households a little bit of factor exposure, a little bit of bond exposure. Maybe at some point they'll be able to tailor portfolios such that there's an appropriate correlation with the household's income risk. They are moving in that direction. At the same time, they're also moving in this holistic financial advice direction, where they're trying to advise households appropriately on both sides of the balance sheet, as well as on their overall savings behavior. And that ties in a little bit to Apurva's comment about financial education. I think robo-advisors have recognized that gap in what they provide, and they're trying to fill that gap. And it's going to be interesting to see how the market evolves over time. Francesco's point about the persistence of investment, yes, and this ties in with the educational comment as well. I think they're recognizing that the robo-advisors are recognizing that it's important to educate households so that when they do reach retirement, they know what to do with their money. I think that's an area in which the market is going, and one small aside, actually, when I used to work at Wealthfront for a brief period of time, when I was working there, they were kind of experimenting with some very rudimentary tools about, having little pop-ups that come up when a household wants to withdraw funds during a market downturn saying, are you sure you want to do this? And I mentioned that just as a simple anecdote to say that, yes, I think the robo-advisors understand that this is an important need they're trying to fill. And again, it's an open question about whether in the future they're able to meet that gap, or whether the market's going to go in a different direction. Again, thank you so much for the excellent comments and the opportunity to talk with you.
All right, thank you so much. So we are at the end of this session. So I want to thank Alberto and Michael for excellent papers and presentations. Francesco and Apurva, thank you very much for your discussions. We're going to take a 15-minute break, and we'll be back at 2 with a panel on big data, machine learning in banking law and economics. Again, thank you so much.